Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today, our weekly whirlwind through all the latest in the mortgage industry. Each week, pleased to be joined by one of our lender members as my co-host. This week, back in the co-pilot seat, the president of Ross Mortgage, Tim Pascarella. Tim, great to see you.
Thanks, Rich. Thanks for having me. Looking forward to it.
Absolutely. Ross Mortgage, longtime TMC member based out of Michigan. We got to start with your Lions. What a year for Detroit. I think all of America was pulling for them to knock Aaron Rodgers out of the playoffs. And like the Dan Campbell interview at halftime about his team, he's like, we just want them out. It was like, I mean, just the red-blooded Americans everywhere were welling up and tearing, listening to that miss old school football and hate these crazy unnecessary roughness penalties. But what a year for the Lions.
Yeah, I mean, Dan is the epitome of Detroit. I mean, this guy was 1-6 out. Media was calling for his job before the season ended. And now, I bumped into him at a restaurant down in Birmingham, Michigan, and this guy can't eat. I mean, he is on a pedestal, and we didn't even make the playoffs. We went 9-8 and missed the playoffs. And, the thing that I'll say about the NFL is you looked at Tampa, you looked at Minnesota, you looked at some of these teams that made the playoffs, and we'd smack them. So next year is going to be a fun year.
I think everybody wanted to see him in over the team that got in the back of the NFC. But next year will be fun. Be interesting to see what they do with Goff, who was phenomenal down the stretch. But just as an outsider, he was so good down the stretch that it would be very hard to not bring him back. But there's going to be a lot of big name quarterbacks out there: Rodgers, Lamar Jackson, maybe Brady.
I got Goff's jersey.
You got a Goff jersey, so you want him back.
6 years in the league, 4 times in the playoffs, a Super Bowl appearance, and he's 28 years old and he wants to be here. You can't ask for anything more.
That's a damn good argument for Jared Goff. So, we will see, but great year for the Lions, and be fun to watch that team going forward. So
for sure.
Let's go ahead and get into it. For those of you just
you don't want to keep talking to Lions?
I could do hours and hours of sports podcasting and video. So
right.
But this is the last week of Mortgage Today. For those just jumping on our weekly whirlwind through all the latest and greatest. This week's co-host, if you couldn't tell, from the state of Michigan, the president of Ross Mortgage, Tim Pascarella. Tim, just some anecdotes from some members of ours coming off the weekend, reporting some of their best app days, over the weekend and to start this week. What say you? Have you had the same experience at Ross?
Yeah, we did last Friday, Fridays, I don't know how everybody else is, but Fridays for us since October have been dismal. And last Friday was one of our largest lock days that I can literally in like the last 5 or 6 months. And then our applications this week, obviously MLK Day, we couldn't lock anything yesterday, but application wise and applications this morning, and just talking to the loan officers, the media in general is it's a mindset thing, right? And the media started talking about the lower rates. The media started talking about how it's a little bit of a buyer's market, even though I think it's a little even, but it's still better than it was. I think is just a bunch of good positive signs for us. But I still look at it like the spigot turned off really fast, and I don't see it turning on really fast. I just see it turning on, which is we'll take it for sure.
We talk all the time about how the headlines trail reality in the mortgage industry. If it's, oh, hey, rates are up. Wait, no, they're down this week. Oh, that's last week's data or production data. And we talked last year about how the sensationalistic headlines like, oh, home value is down, 30% annualized. Okay, they're down like 0.5% month over month. And, so, but the flip side, so I feel like those headlines kind of maybe hurt housing.
It did.
Back half of last year. You read that crap all the time. You're a potential home buyer or seller, right? You just don't want to deal with it. Now we may see the flip side of that because you're starting to hear a lot of headlines about rates dropping, inventory rising, activity starting to pick up. And so it could help us this time around.
Yeah, I think the media, it's funny how they twist things, right? I didn't tell you anything you didn't know. When they said it was down, they're basing it on a non-sales price. Right. So when a realtor calls you up, I mean, if you're on the streets and a realtor calls you up and says, yeah, you could have sold that house for 950,000, but today you could probably only sell it for 9. The value of your home didn't drop $50,000. You never sold it for 950. No house near you sold for 950. It was just word of mouth, right? So I think that I actually think, and I think there's been a lot of reporting on this. I think we still get a couple ticks this year. I think the values of homes go up this year. I just think that what we've been accustomed to the last 2 or 3 years, not even close. But I absolutely think you're right, Rich. I think if rates go down and inventory ticks up not too much, you don't want to over inventory, but if it just ticks up a little, I actually think the demand's there for sure.
I agree. I think there's a ton of demand to buy houses. I
Mhm.
mean, people that, one day one of these real estate companies or somebody will put together a survey on this, but my sense is that there's a lot of people that would like to buy a house in
Mhm.
2023. May not be realistic for everybody due to a number of reasons, but yeah, certainly a lot of demand out there. And, I think that it's just, you know, it's, as far as values, I agree with you as well. I mean, we had basically the first 2 years of the pandemic, essentially 30% on
Yeah.
average nationally, right? You get a little bleed off last year. Let's just, for argument's sake, say nationally we lost 5% of that. You're still 25% over 2.5 years in an industry.
Insane.
There's 3-4%. When you strip out all the stuff you got to adjust, it's pretty damn good.
When you're making 25% and you don't put a penny into your house, that's pretty impressive.
Yeah,
I
I
mean,
agree with you. I think values are going to stabilize this
I
year
do
and go
too.
up a little bit. Honestly, I really do,
I
uh,
agree.
because of that ultimate demand. And I think some of the things that are starting to happen to help, kind of beat down the headwinds um, that are flying in the face of the real estate industry right now. One of those, normally for us Midwesterners, you're outside of Detroit, I'm outside of Cleveland, is this damn winter weather. But we were kind of talking about before I went live. I just went outside and got the garbage cans, and like everything's melting outside. I got temps in almost 50 degrees in Cleveland, and that helps a ton in the Midwest when it comes to home purchases, right?
Yeah. I'm a big snowboarder and I've come to the conclusion I don't mind traveling to snowboard. I don't want to snowboard in Michigan. So, I was telling you before I came on, I'm on the 7th floor here and I have a big subdivision that I can see. And I love it when it's January and there's no snow. Especially in the Midwest states. I mean, no one wants to buy a house with 2 feet of snow on it. So I think that we're blessed big time for there. And I think, and I mean, I don't know, knock on wood, but take a look at the 20-day forecast. It's just, I mean, I don't know. I look at it like every week goes by, we're that much closer to spring. So it just doesn't look like this is going to be that massive of a winter. Everyone knows it can change, but it's looking pretty good so far.
Oh man, I hope you're right. That would be great. And yeah,
Yeah.
it would be another catalyst for our industry here in the first quarter. And you're starting to see some catalysts line up to send the momentum the right way in a good direction, continue to get good economic numbers as it relates to inflation and kind of that waning to a more healthy level. Got a big inflation number last week. CPI, Consumer Price Index, right in line with economists' expectations, actually dropped consumer prices as a whole month over month. If you look at inflation the last quarter in a vacuum, it still is a little elevated, but not too far elevated over healthy levels. Now, again, there was some rampant inflation the years that led into that, but starting to look and feel like the Fed, their actions are working. Maybe they acted a little bit too late, but it's starting to look like their actions are starting to take hold.
Yeah, it's going to be an interesting year with inflation. I don't know how it's going to work, right? I mean, like now I'm 45 now, so I can tell you I've seen like gas, right? I've seen gas $2 like 4 different times. I've also seen it $5 4 different times, right? So it's going to be interesting to see where it settles at, because everything pre-pandemic was so, and even during the pandemic was so cheap, and I don't think they can go back to that. But I think it'll be a very interesting year. I hope I'm not paying $7.50 for eggs at the end of the year.
It's
You
been
know?
crazy. I mean, first with the pandemic, just the craziness of that in general, but the supply line issues. I remember, 21 and 22 was like, it was baby formula or whatever the hell it
Yeah.
was, like something that is ridiculously expensive because because we're almost out of it. And just the prices of things too. It just got all kind of jacked up due to unforeseen global event.
Yeah, it really is. I'm interested to see. I mean, there was rumblings out of the Boston Fed and the New York Fed that they're suggesting to Powell to go 25. And if that happens, it'll be really interesting to see what happens. I mean, Boston and New York aren't small cities. I mean, if they're telling them, if they're suggesting it, then it might hold some weight. And that would be very interesting to see what happens there. My prediction, not that it matters, but my predictions, I really do think we'll be in the low fives by April.
Such a delicate dance that Chairman Powell and the Federal
Yeah.
Reserve have to walk, I think, by their own admission now, a little too late to the game with the inflation is transitory, and then, forced to take a more aggressive and more hardline stance than they otherwise would prefer to deploy. And now, even, kind of where they are right now is the data and the numbers are starting to look better. If you just look at the numbers in a vacuum, it looks like what the Fed is doing is working.
Yeah.
Their words and their actions are they're just trying to scare the crap out of people, essentially, to keep expectations down and not have like stocks and bonds start going crazy off a couple of good numbers. But eventually, they're going to have to admit what they're doing is working, and they're going to have to eventually think about reducing the pace of these 50, 75 basis point hikes. Because to your point, there's some people starting to call for 25 at the next meeting now.
Yeah, I think it's going to be an interesting down. It's clearly it won't be like 2020, right? There's none of this. The question is how many spikes until April or May, in my opinion, how many spikes and how bad are those spikes going to be? Because I think we get down there, right? I think just through the CPI data on May 10th and the announcements of possibly making it a quarter, I definitely think we get down. But like you said, it's such a delicate balance. I don't envy any of their jobs because it's their words, right? It really there doesn't even need to be data behind their words. It's just what they say can literally just cause these huge upward and downward swings. So it's going to be interesting to see how we get back down, I guess is a way to say it. But and then what's low? I mean, before the pandemic, I'd have told you a 5% interest rate's free money. Let's go. So I mean, it's going to be interesting to see what the new level is. Is the new level 5.5? Do they never want to go to 5 or make 5 a catastrophic event to get to? You know what I mean? Like, what's the new level? Because I feel like that's gas, right? I feel like they pumped it up to $5. We bitched and bitched and bitched, but we got used to $5. So now if it goes to 3, we'll forget about 2, and 3's awesome. And it's like, so what's the new level with interest rates? Because it will not be the 4 years prior to the pandemic where it was like 4.5. I don't think that's the new level, right? So it'll be interesting to see what happens.
It's fascinating because like the history of how mortgage rates have moved, more in more normal times, it's like, okay, good economic news. The stock market, is going to rally and bonds are probably going to sell off and rates are going to go up a little bit. If you have economic uncertainty in any level, investors flock to the safety of fixed income, mortgage bonds. So, just my history as a secondary guy, it wasn't quite this simple, but like bad economic news, good for mortgage rates, and good economic news, bad for mortgage rates. Now it's totally different. Interest rates, mortgage rates are completely fueling off of expectations of what is to come with regards to inflation as it relates to economist projections. And it is interesting because you're right, there really isn't, it seems like there's not a floor. Like you've made the point a couple of times before, like I don't think we're going to see some like crazy drop in rates, because it would be hard for that to happen right now, because ultimately inflation eats away at the return of fixed income assets like mortgage bonds, and there's still too much uncertainty and fear out there on inflation,
right?
Have that floor be low. But we're dealing what are we, 6.3, 6.4 right now, 30-year fixed?
Yeah, I think the national average is 6.4, something like that. Yeah, I failed microeconomics, but I killed it in macro. And I think one of the biggest things that's going to be interesting if we do go into a recession is you just nailed it, right? One of the easiest things to do during a recession is put $150 to $175 in everyone's pocket, right? So we go into a recession, we'll lower rates so much lower than the average interest rate of the home zone. Everyone refinances, everybody gets $150 more or roundabout numbers. And in a macro scale, that's a ton of money, billions of dollars, trillions of dollars that we can flood back into the market, right? We're coming off 2.5% interest rates. You like I laugh, I don't laugh, but I question my salespeople. They're like, well, man, this next, I'm getting ready for the refi boom. We just had the worst year in 20 years. What boom are we gonna do? I'm like, yeah, you're gonna be able to refinance them, but you'll have 40% runoff. So now take 40% of the worst year you had, and now you got that, right? You got 20% of them who just won't do it. I mean, all of a sudden it's not that big of a boom, so it's going to be interesting to see what they do if we in fact, head towards a recession, which, even though I hate when people say, oh, recession is good for the mortgage. No, it's not. Recession's not good for anybody. But I don't know, it can't be their safety net like it has the last couple. The last couple, it was so easy to just get everybody to refi, pump money back into the economy. I don't think it's going to be that easy this time. So it'll be interesting for sure. I think the biggest thing, well, we'll get to it, is when we get to the refi portion. We'll get to what I think is going to be a boom.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of Ross Mortgage out of Michigan, Tim Pascarella, and starting to dig into some of the news headlines of the last week. Tim, big one: Wells Fargo exiting the correspondent business. Big, massive, giant in the correspondent space for many years. At one point, I remember them having damn near 25% market share. I remember since then, kind of a slow bleed off. A lot of the regulatory, just tough for big banks to be in mortgage in a lot of ways. But your thoughts on that big news from last week?
I guess the biggest question I have is why. I mean, I have some conspiracy theories, right? Like I have some theories on why. They had 7.9% of the servicing in America. And I mean, make no mistake, people, businesses all alike need cash. And I think it's an amazing time to sell servicing. So that could be it. I don't worry about capacity. I don't worry about correspondent channel at all. I think that PennyMac, AmeriHome, and Planet all did backflips when they heard the news. I mean, they'll just grow by attrition, right? So I don't think there'll be an issue at all. I think it'll be better for our pricing, because I do think that Wells was so dominant that people just backed off because they didn't want to deal with it. Now I think that all around we'll get better ticks in pricing. Again, just an opinion, but I think that'll be the case. But just more or less, if they were in front of me today, like not that they ever would be, but if they were, I'd just be like, so I'd love to. You've heard 50 reasons why people think they did it. I'd love to hear why they really did. I looked it up, and I really haven't seen that good of a detailed article of why. So I just guessed.
Official statement, alluding to they're staying in mortgage on the retail side and want to focus there. And as the winds change, how they allocate resources, the bank, it's kind of like one of those statements. City Mortgage did the same about a decade ago. Like completely got out. I remember.
Yeah. Well, and that's another thing, Rich, you nailed it too. I mean, this isn't new. When the spigot does what the spigot did in 2022, there is usually a very large player. Remember Principal?
Yeah,
they did it too, right? I mean, they were huge, man. There's usually a big player that just, for some reason, right, never really says why, gets out. And it's usually one of the top three, right? Citi was easily one of the top three when they did it in 2009. Principal was top five. Wells is, I think, number one. So I mean, it didn't surprise me. I just never really understand why. And here's the thing: they always come back.
They'll be back. Yeah, I mean, honestly, you look at the big banks and mortgage, and I never worked for a bank that big, but just knowing, like, at the end of the day, big banks, they dislike the mortgage industry. No, dislike is the wrong word. They have to offer it because they have to offer the solution to all their retail customers all across America. At the same time, the regulatory eye on a big bank, and we've just seen this with the stuff that's come out, Wells and Chase, like it's a nightmare is a nightmare to be in the mortgage industry. Then you just take the seasonality of it and having to fire people and hire people and the inefficiency of all that madness. But they kind of got to be in it on the retail side. So,
They
you know,
do.
Chase,
Isn't that for
US,
their FDIC insurance, right? Like they have to.
yeah. So if they're in it on correspondent, I mean, Chase and US Bank have kind of stayed in the correspondent game
Mhm.
over time, but they bop in and out as far as their aggressiveness level. Wells is now bopping out. City bopped out. They're bopping back in a little bit. It's, as the it's like sands through the hourglass. So
Yeah. Well, what surprised me about Wells is I thought what they were going to do, and I thought they were just going to price themselves out. I didn't think they'd actually announce that they were out. I mean, you got to understand these guys are such huge players. All they got to do is go behind the curtain, crank up the switch, and they'll stop anyways.
mhm.
I mean, all these correspondents. I mean, let's not kid ourselves, right? I mean, unless there's some sort of a reason we don't like you, we'll sell to the highest bidder,
Mhm.
right? So I thought what they were going to do is just crank the needle way down and
Mhm.
just make it so they don't win anymore.
Yep.
So I was a little surprised by what they did, but I mean, as far as a local small correspondent in the Midwest, okay, it's just next up.
And you mentioned it. Wells, one of the biggest servicers in America, I think serves
Yeah,
9% of all loans. They also mentioned in the release that they were going to, start bleeding that
selling.
off.
Yeah,
Um, and already right now, you also mentioned it earlier in the show, a lot of MSR activity. Independent mortgage banks like Ross either looking to sell MSR, one because they think it's a good time. I would agree with that, and two to maybe bring in some cash to help with things in the new year. So a lot of MSR activity already. Got
yeah,
to imagine like the Fed with mortgage bonds that they're going to start kind of slowly reducing the size of that portfolio and start bleeding some of that stuff off into the marketplace. So
yeah. I mean, my only comment on that is cash. I mean, 2022, the year flipped. You're in 2023. You're preparing for what would suggest to be another off year. I won't say any. I don't know if you can get as bad. We're in for a whole new set of problems if 2022 repeats itself, but it's definitely going to be another off year. And I think cash. I mean, I've seen just in our small little community of people, I've seen so many servicing sell-offs. And I think also, Rich, you nailed it too. I mean, it's no different than why you shouldn't have sold. You should have sold your house in March of 2022. I mean, it's a really good time to sell servicing. I don't know if you're gonna get the value in 2 or 3 years.
yeah, I've tried to ask a couple people smarter than me on this show and the one I do with Chrisman, like the buyers, because there are still buyers, and I guess the prices are a little depressed. That's part of it, but still a lot of people out there buying servicing, 30-year
Oh
fixed
yeah,
rate servicing in the sixes. And I guess all I could say to that is the conventional wisdom, like we sat here and talked about it, is that rates are going to slowly decrease throughout the year. We're going to have healthy climate, but we also know never is the mortgage industry where you thought it would be 12 months earlier.
no,
Me and you have been in this a long time. We're sitting here saying, you know what? Probably pretty likely like rates slowly reduce this year and we have a better year than last year, but not like a banner year. But history says we'll be wrong.
yeah, history's a word I never know. I never know. I mean, I would have never guessed 22 was going to be like it was. I mean, clearly 2020 was amazing. 2021 was amazing as well. No one thought 2022 was going to match any one of those years. I did not think it'd fall off the cliff either. So I think it's one of those things where you got to prepare for it and be ready for it. We were, thank God. But it's interesting. Just like you said, right? I can sit up here and guess anything I want in 2023, but I don't know. I'm gonna do whatever
We could
2023
be
brings.
co-hosting this show in 3 months and we could be talking about being in the middle of the refi boom we think is impossible.
Yeah, exactly. Exactly. Exactly.
Like,
It's insane. I
when-
do think as far as refis go, the one thing that I don't want to say hanging my hat on, because I mean, I've always been a purchase money market in this business, but the one thing I'm hanging my hat on, and I don't care what Fannie and Freddie do about LLPAs and stuff like that, we are sitting on the most equity we've ever had in our entire lives. And we came off one of the worst, I'll call it rocket inflations that I've ever seen, that I've been a part of, that I've been tracking this stuff. And credit card debt is at an all-time high. And I do believe, I believe that our cash out refinance. Now, I'm not the media. I'll tell you, when I say doubled, that means doubled from almost nothing. But it's gone way up because Christmas is over, the holidays are over. You wake up from that blackout affair, and you look at your credit report, you're like, holy shit, I'm spending $750. And when the Fed raises rates, credit cards get hit the hardest. I'm averaging 21% on these credit cards. I'm paying $700, sometimes $1,000 a month in credit card bills, where if I just flip this all into one, I'm going to be paying $250. So I think if rates go down in the mid to low fives, I just think people will jump all over cash outs. I think investors right now are using cash to buy homes instead of borrowing. I think that'll come back. So there are definitely things that'll come back that'll make that low rates will trigger more deals. I just think the macro aspect of it, where you're going to get everybody to get $150 a month, that's not it. But I definitely think people will start tapping into that equity for sure.
Very well said. Record levels of home equity, record low delinquency.
Yep.
I think we are both making the argument that there is incredibly strong demand to buy houses. And the most important part of qualification, employment, the labor market, also very healthy. So a lot of things going for housing. And I think you're right. I mean, I think the kind of emotional significance of getting into the fives, I think that even a little bit more rate relief, you're going to start to see, lenders aggressively marketing it, even if it's, a little bit of smoke and mirrors. And I just think that will, coupled with warmer weather and news headlines about, positive housing movement and momentum, and could be we could be sitting here on the show in a month and talking about great activity and nice pipelines.
To your mouth, to God's ears.
I can't have a Michigan guy on it without asking you, about all the Michigan mortgage mafia up there. You got like Michigan taking over the world with Rocket, UWM, and Home Point. You got the three biggest wholesale lenders in Michigan, and I noted it because Jay Farner, Rocket's CEO, was on CNN the other day, and he made a comment I thought was accurate. Wanted to get your thoughts on it, that buyers and sellers kind of like an even hand right now. Obviously, sellers so much of an advantage. Just buyers, I don't need an inspection, I don't need anything. Like just it's a little tighter.
Whatever I got to do.
Seems like it's more buyers and sellers, a little bit more even-handed now.
Yeah, Jay's. So yeah, I'm in Metro Detroit. I'm the Charlotte, North Carolina of the '90s. I'm like the mortgage mecca of the world. Jay's awesome. He's a good buddy of mine. He nailed it. He absolutely nailed it. This is as even. This isn't a buyer's or a seller's market. It's just even. I got a couple good friends of mine that just bought homes, and there wasn't that crazy pressure to get in before everyone else. There wasn't that offer over price. It was simply they offered the listing price with a little bit of concessions, and the seller took it. It's a very even market. I don't think either one's better than the other. We need inventory for sure. There are things we haven't even touched on that would really make a difference. Is the supply. There's still a very, media doesn't want to talk about it. There's still a huge supply problem with builders. I mean, the builders, I can't believe no one talked about December. 4,000 new builds were abandoned in the United States. That's an insane number, and the majority of them that they didn't want to talk about was because they got approved in December of 2021 and they couldn't pay the bill. When the bill went up $600 a month in December of 2022 with inflation and everything else, they weren't even approved. So, that number to me is startling, but that also is a direct problem with supply. It took them a year to build the homes. If the builders could get their supply back in order, I think that alone could cause a spike, for sure. So I think that's something we still got to get our arms around and fix. It can't take 6 months to get a washer and dryer. It just can't. You know, we're in Metro Detroit, Motor City. You still got to order your cars 4 or 5 months in advance. I can't even imagine what it's like outside of Michigan. You know, I mean, at least these cars are like within 20 miles, you know, sitting with no chips. I can't imagine what it's like to get one in California, you know, so there's still a big supply issue that could help the buyer and seller market with these new builds. But I do agree with what Jay said, and it's a very even playing field for buyers and sellers right now, which is good for the market.
Tim, great stuff as always. Really appreciate you joining me on short notice this week. You're a guy we know we can go to at a moment's notice for a coherent and intelligent discussion on our industry. Once again, you came through. Thank you very much for joining me this week.
Thanks for having me, Rich. Have a good one, bud.
Absolutely. To our attendees, thanks as always for joining us. We're here every Tuesday at 2 p.m. Eastern, our third year doing the last week in mortgage today. The goal is to kind of get you outside your silo and give you some perspective on what's going on in the rest of the industry. So until next Tuesday at 2 Eastern, have a great rest of the week, everyone. Take care. Thanks again, Tim.
Yep. Take it easy.